Most people believe the stock market is dangerous during a crisis. I've always believed the opposite. In fact, if there's one idea that has quietly shaped my entire investing life, it's this. The moments that scare people the most are often the moments that create the greatest wealth. Not overnight wealth, not lottery wealth, but durable, life-changing wealth that lasts decades. And I want to be very clear about something right from the beginning, because this matters deeply if you're watching this later in life. You don't need a crisis to make your first million. You need a crisis to make your second one. That may sound strange at first, especially if you lived through 2008 or 2020 or even the inflation shock we've seen more recently. Those periods didn't feel like opportunities. They felt like threats. They felt like moments where everything you worked for could disappear. And that fear is understandable. I've felt it myself. I've lived through market crashes that wiped out fortunes, shut down businesses, and ruined confidence for years. But with time, I learned something most people never do. Fear doesn't destroy wealth. Reacting to fear does. When markets fall, people start asking the wrong questions. They ask, should I sell? They ask, what if this gets worse? They ask, what if I never recover? But those questions come from the same place, short-term thinking. I learned very early that the stock market is not a place to run from fear. It's a place to wait patiently while fear does its work. Now, if you're watching this and you're somewhere between 45 and 75 years old, I want you to hear this clearly. The opportunity I'm talking about is not the same opportunity a 25-year-old has. You're not trying to gamble. You're not trying to chase the next hot thing. You're not trying to impress anyone. You're trying to protect what you've built and grow it intelligently. You're trying to turn experience into advantage. And that's exactly what market crises offer, if you know how to approach them correctly. Let me take you back for a moment. In 1973 and 1974, the stock market fell nearly 50%. People thought capitalism itself was broken. In 1987, the market dropped more than 20% in a single day. In 2000, the technology bubble collapsed and wiped out trillions of dollars. In 2008, the global financial system nearly froze. In 2020, the world shut down almost overnight. Each time, the headlines were terrifying. Each time, people said, this time is different. And each time, the same mistake was made by the majority. They focused on what they were losing instead of what they were being offered. You see, the market doesn't just go down during a crisis. Prices go on sale. And the problem is not that people don't understand sales. The problem is that they only like sales when they apply to things like clothes or cars. When stocks go on sale, suddenly everyone forgets how math works. They forget how businesses work. They forget how time works. When I buy a business or a piece of one, I don't care what someone else thinks tomorrow. I care about what that business will earn over the next 10 or 20 years. A crisis doesn't destroy that future. In many cases, it strengthens it. Weak competitors disappear. Strong businesses gain market share. Management teams become disciplined. Costs are cut. Prices stabilize. And the long-term owner benefits. Now, before I explain the 3 ways I've consistently used market crises to build lasting wealth, I want to slow you down for a moment, because this is where most people miss the real lesson. The goal during a crisis is not bravery. It's clarity. You don't need to be bold. You need to be prepared. Fear is not something to fight. Fear is something to understand. Every crisis does the same 2 things at the same time. It creates uncertainty about the short term, and it creates opportunity for the long term. The people who suffer are the ones who confuse the 2. They treat short-term uncertainty as permanent damage. The people who succeed do the opposite. They treat short-term pain as temporary noise. When I was buying stocks in the depths of past crises, I wasn't trying to predict when the market would recover. I've never been good at that, and I don't think anyone else is either. What I was doing was far simpler. I was asking myself one question: will this business be stronger 10 years from now than it is today? If the answer was yes, the price mattered less than the value. And that brings me to the first way market crises create second million opportunities. Though I want you to notice something. I didn't start with a list. I started with a mindset. Because without the right mindset, the methods don't work. The first way to capitalize on a market crisis is to separate price from value when everyone else can't. During a crisis, prices fall faster than values. That's not an opinion, it's a fact. Prices move on emotion. Value moves on business results, and emotion moves much faster than reality. When fear spreads, stocks are sold not because the business is broken, but because people want relief. They want certainty. They want to stop feeling uncomfortable. Let me give you a simple example. Imagine you own a small grocery store in your town. It's profitable. People need food. One day, panic spreads. People stop shopping for a few weeks. Would you sell your store at half price because one bad month scared you? Of course not. But that's exactly what happens in the stock market every crisis. Perfectly good businesses are offered at prices that assume the worst will last forever. In 2008, I invested billions of dollars into companies that people were afraid to touch. Not because I was fearless, but because I was focused on earning power, not headlines. Banks were scary. Insurance companies were scary. Consumer companies were scary. But fear didn't erase the fact that people would still borrow money, insure their homes, and buy everyday products. This is where older investors actually have an advantage. You've lived through cycles, you've seen recoveries. You know life doesn't move in straight lines. Younger investors talk about risk. Older investors understand it. Risk is not volatility. Risk is losing purchasing power permanently. And when you buy valuable businesses at depressed prices, volatility works for you, not against you. Now, the second way market crises create opportunities is more subtle, but just as powerful. It's something most people never think about until it's too late. Crises expose leverage, and leverage tells you where safety really is. Every boom hides leverage. Every crisis reveals it. Companies that looked strong suddenly collapse. Why? Because they were standing on borrowed money. Individuals who looked wealthy suddenly panic. Why? Because their lifestyle depended on constant growth. When markets rise, leverage feels invisible. When markets fall, it becomes painfully clear who was swimming without a life jacket. One of the reasons I've always preferred businesses with strong balance sheets is simple. They can survive when conditions turn. They don't need perfect markets. They don't need cheap credit. They don't need constant optimism. They can wait. And in investing, the ability to wait is everything. During crises, companies with little debt don't just survive. They gain power. They can buy competitors. They can negotiate better terms. They can invest while others retreat. That's why, over time, capital flows towards strength. And that's why crises reward patience. For someone thinking about a second million, this matters enormously. The first million is usually built through work, discipline, and saving. The second is built through positioning. It comes from owning assets that grow while others are forced to retreat. It comes from understanding that survival is the foundation of compounding. I've always said that you don't find out who's been swimming naked until the tide goes out. A crisis is the tide going out. And if you're positioned correctly, if you own quality, if you avoid excessive debt, if you maintain liquidity, you don't just survive the storm. You become stronger because of it. This brings me to the third way. Market crises create extraordinary opportunities. And this one is the most important of all. Crises reset expectations, and low expectations are the investor's best friend. When expectations are high, even good results disappoint. When expectations are low, even modest success creates value. This is something Wall Street often forgets, but long-term investors should never ignore. Markets don't move based on how good things are. They move based on how reality compares to expectations. During a crisis, expectations collapse. Analysts lower forecasts. Investors assume the worst. The bar becomes very low. And that's when ordinary outcomes produce extraordinary returns. A company doesn't need to thrive. It just needs to survive better than feared. Think about it this way. If everyone expects disaster, stability looks like success. If everyone expects failure, survival looks like growth. That shift in expectations is what drives recoveries long before headlines turn positive. In 2020, the economy was shut down. Entire industries were written off. But within months, businesses adapted. Consumers adjusted, systems evolved, and the companies that could function in difficult conditions became far more valuable than anyone expected, not because the world became perfect again, but because the worst-case scenarios didn't come true. This is why I've always been skeptical of predictions. The future doesn't need to be bright to be investable. It just needs to be less bad than feared. And during a crisis, fear is usually excessive. Now I want to pause here and talk directly to you, because this is where many thoughtful people hesitate. You might be thinking, this all makes sense, but what if I'm wrong? That's a reasonable question. And the answer is not certainty. The answer is margin of safety. I've never invested on the assumption that I was perfectly right. I invest assuming I could be wrong, and structure my decisions so I don't get hurt badly if that happens. Buying strong businesses at low prices provides that margin. Avoiding excessive debt provides that margin. Keeping cash available provides that margin. The goal is not to predict the next crisis. The goal is to be ready for it. And readiness is what turns fear into opportunity. When markets fall, the real cost is not financial. It's psychological. People abandon good ideas because they want relief. They sell at the wrong time, not because the math changed, but because their emotions did. That's why temperament matters more than intelligence in investing. You don't need to be smarter than everyone else. You need to be calmer. If you can remain calm while others are fearful, not reckless, but thoughtful, you place yourself in a very small group. And that group is where long-term wealth is built. Let me say something that may surprise you. I don't enjoy market crashes. I don't celebrate them. But I do recognize their value. They clear excess. They punish speculation. They reward discipline. And for someone thinking about a second million, they offer something rare, the chance to buy enduring value at temporary prices. The older I get, the more convinced I am that success in investing comes down to a few timeless principles, repeated patiently over time. Understand what you own. Pay a reasonable price. Avoid leverage that can force decisions. Keep your emotions in check. Let time do the work. A crisis doesn't change those rules. It tests them. So when the next crisis comes, and it will because markets are cyclical, I want you to remember this. The pain you feel is not a signal to run. It's a signal to think. The fear you see in others is not proof of danger. It's evidence of opportunity. And the patience you exercise in those moments is not inactivity, it's discipline. The second million is rarely made in calm waters. It's made by those who prepare in advance, act thoughtfully when others panic, and remain focused on value when price dominates the conversation. In the end, investing is not about being fearless. It's about being rational when fear is everywhere. And if you can do that, even imperfectly, you'll discover something remarkable. The very moments that once worried you become the moments you're most grateful for. That's how crises build wealth. Not through drama, but through discipline. Not through prediction, but through preparation. And not through luck, but through patience. And patience, in my experience, has always been the most valuable asset of all.